Good morning, everyone, and thank you for joining us for today's Barron Funds conference call. My name is Frank Majorano, and I'm the head of the Registered Investment Advisor and Family Office Group at Barron Funds. Today, we're going to be discussing the Barron Global Advantage Fund, the Barron Fifth Avenue Growth Fund, and the Barron Durable Advantage Fund. We'll be speaking with Portfolio Manager Alex Umansky and Assistant Portfolio Guy Tartakovsky. I wanted to note that in 2022, the Barron Global Advantage Fund was awarded the winner of the Refinitiv Lipper Award for being the best global multi-cap manager over the past 5 years. And through the end of 2022, since the fund's inception in 2012, the Global Advantage Fund has outperformed the MSCI ACWI Index, the MSCI ACWI Growth Index, and its Morningstar peer category. So congratulations, Alex and Guy. I'd like to encourage everyone listening to submit questions either in the Q&A box on your Zoom or by emailing us at questions@barronfunds.com. We've already received a few questions in advance of the call. So let's go ahead and get started. Good morning, Alex and Guy. Alex, to start things off, you have a lot of loyal investors out there and a lot of folks on the call today, but not everybody knows about each of the three funds that you manage. So I thought maybe we could take a step back, and can you give the audience kind of a quick overview of the three different funds that you manage, their mission, and the addressable market that you think about for each fund?
Sure. Hi, Frank. Hello, everyone, and thank you for taking the time to join us today. So as hopefully most investors know, all Barron funds share the same philosophy and the same core values or investment principles that portfolio managers or PM teams apply to different segments of the market. Long-term ownership and a growth mindset are fundamental or core to every strategy at Barron. We all try to identify and invest in unique, high-quality businesses that are managed by talented people with good track records of being successful capital allocators, and probably most importantly, competitively advantaged businesses that we believe will enable them to compound their intrinsic values for a really long period of time. As you, Frank, mentioned, Guy and I manage three different strategies: global all-cap growth, U.S. large cap growth, and U.S. large cap, post-high growth, as we think of it. Global Advantage and Barron Fifth Avenue Growth are designed to be the big idea funds. It's all about disruptive change, building platform businesses with power law distribution and network effects. And it's about investing in companies in the earlier stages of their growth life cycles. These businesses are typically either the creators or the disruptors or the major beneficiaries of disruptive change in fast-growing industries that we expect or believe have the opportunity to become significantly larger than they are today. These companies also have high and typically rising returns on invested capital and spend years and sometimes decades reinvesting all their cash flows back into the business, and as a result show little or no current earnings. The difference between the two funds is their investable universe. Global is currently 55% outside of US, 30% emerging markets, I think maybe 35% small and 30% mid-cap, whereas Fifth Avenue is 80% US large cap and 20% kind of foreign large cap or maybe US mid-cap. The two funds typically have 40 to 50% overlap, where the highest conviction US large cap big ideas will make up 20 or 25% of global, and then the highest conviction large cap ideas that are outside of US will make up that 20% of Fifth Avenue. Now, durable is very different from both and has little to no overlap, certainly with global, and now probably maybe mid-single digits even with Fifth. Durable Advantage is designed as a home for high-quality, competitively advantaged businesses that no longer have the ability to reinvest all of their access-free cash flows at high rates of return, and rather than accept lower returns, choose to use that capital for dividends and share buybacks. In other words, they would rather return the excess capital back to shareholders than dilute what typically are very highly profitable businesses. So these are typically leaders of industries that are more mature, consolidated with kind of proven pricing power and leading market shares, but growth prospects in the high single or low double-digit range. So still growth, but definitely more GARP rather than big ideas. And the goal here is to outperform the S&P 500 over the full market cycles without taking on much risk of permanent loss of capital. So in a nutshell, Frank, global advantage is big ideas, best ideas, kind of unconstrained equity anywhere in the world. Fifth Avenue is big ideas, long duration, but in the US large cap world. And then durable is high quality, proven businesses, lower vol, current free cash flow generating things.
Perfect. Thanks for that, Alex. So today, January 31st, Matt, marks we're exactly a month into the year. All your funds are off to a strong start. You're meaningfully ahead of all the benchmarks, but we also have a busy week in earnings. January this year is the best January we've had since 2019. And 3 of the last 4 months in the market have been positive. But as refreshing as that is to say, 2022 was a challenging year for your funds. So it probably makes the most sense to maybe start off by talking a little bit about your fund's performances last year. And as you talk about it, can you tell us maybe, was it due to more industry or your style, stock selection, and maybe frame it in line with your other years where you've had some really strong performing years? And was your underperformance last year actually in line or consistent with why you outperformed in prior years?
Well, I guess challenging is probably an understatement. Although durable actually held up okay. Durable was down 24.8%. It was one of the smaller drawdowns among all of Barron funds, within the striking distance of its benchmark, and it can certainly be put in the context of being up over 32% the year before and over 30% on average over the last 3 years. So 500 basis points over S&P 500 on average from 2019 to 2021. So that kind of makes sense intuitively, I think, to most people to put it in the framework that you just did. So we were okay with durable. Unfortunately, global and fifth lost more than half of their net asset values, and that's really hard to stomach, let alone to explain. Yes, we had a long period of outperformance, and as you mentioned, at times massive outperformance, especially in global. Still, this kind of a decline, I don't want to call it a loss because we do not believe it will result in a permanent loss of capital, but we do mark to market, and we have to own it. And it was just an awful year. I don't have any kind of other adjectives to describe it other than awful. Global is larger, and it was kind of down a bit more. So with respect to global, roughly 80% of our underperformance can be attributed to industry or style factors, according to Barra. In a neutral year, that would be it. And in a good year, the remaining 20% would actually, be good stock picking that would help us offset being in the wrong place at the wrong time. But, not in 2022, where pretty much every decision that we made appears to have compounded the downside. Let me give you a couple of examples. We owned Meta Platforms, also known as Facebook, for almost 10 years. We decided to sell what was a pretty sizable stake at the end of 2021, close to the all-time high, making it one of the most successful investments in the history of the global strategy. And Meta was down 64% in 2022. So how could this possibly be a bad decision, right? Well, it could if one decided to take all of the proceeds from the sale of Meta and invest it into Rivian, which went down 82%, which is more than down 64% for Meta. So the 20% of underperformance that was due to stock specific or due to stock picking, half of that was Rivian. We made what looked like great sales in many different companies, Opendoor, SoFi, RingCentral, Dynatrace, even Alphabet and Alibaba were, sold at much higher prices than where they ended the year. The problem is that we invested the proceeds into Snowflake, Nvidia, and Tesla, and that went down even more than the things that we sold, and in some cases down much more. Like Tesla was down 54% in the fourth quarter alone. At some point, we decided to take a tax loss on Rivian and swap it into Tesla, which was already down, I think, 30 or 35%. And like 2 days later, Elon decided to buy Twitter. And honestly, it was like this can't be. I remember talking to my wife and telling her that Ron must have told Elon that Umansky now finally owns Tesla, and then Elon buys Twitter just to mess with me. Like I literally at the time couldn't think of any other reason why he would do this other than just to hurt me. So it was that kind of a year, pretty much. We zigged every time we should have zagged. Nothing worked, and that was sort of the story of 2022.
Okay, so I guess I have to ask, did you learn any lessons from last year, and would you do anything differently going forward?
Right. Lessons learned. Well, there are many, and we're obviously still processing them because we're still in the midst of a storm, and it's a little bit early. But unfortunately, as with prior experiences of this sort, like the global financial crisis or the dot-com bubble, you learn what not to do and kind of what doesn't work, and not so much what you should have done or what would have worked. I mean, Rivian was such a unique situation, and so many things had to go wrong in precisely the way that they did in order for us to kind of get stuck with it. And it ended up costing us almost 500 basis points, which is basically the most we would ever commit to any single investment at cost. Lessons: sell faster, sell harder, especially earlier stage businesses where risk of permanent loss of capital is clearly higher, or more present, and basically restrain yourself from buying anything because cheaper or even a lot cheaper doesn't necessarily mean cheap. And then, of course, redemptions are inevitably coming during times like that. And if you spend the cash that you raised, you instantly need to go and raise more. I actually think Guy spent a fair amount of time analyzing and backtesting what we did versus what we could have done to mitigate this. So this is probably a good spot or a good segue for Guy to chime in.
Yeah, so
Guy?
Yep. Thanks, Alex. So we looked at a few things, in terms of how 2022 has evolved. One was, looked at the mega caps, right? One alternative was, once we saw the regime changing, was to put more money into the proven mega caps, right? the Googles, the Amazons, Nvidias, Metas of the world. The thing was that in 2022, they all came down between 40 and 64%. 40 was Google, Amazon was 50, and Meta was 64. So that wouldn't have helped materially or at all. Similarly, we looked at companies that are further along the unit economics maturity curve. So companies that already have significant free cash flow margins, in the 20 to 40% range. So very significant, yet still growing rapidly. So I'm talking about companies like CrowdStrike, which is the cloud cybersecurity leader, or Endava, which is the enabler of digital transformation, or Datadog, right, which is the cloud observability platform. All of these guys were down between 49 and 59%. So that wouldn't have helped as well. The last bucket we looked at was companies that were significantly cheaper, yet at slightly lower quality, or perhaps a little bit less of a big idea. and what we call kind of 90% the quality for half the price. And here also, it was a mixed bag, right? We had companies such as InPost and Afia, which were actually two of our top 5 contributors for the year. But we also had companies that declined a lot, right? That started from a cheap price, from 12 times EBITDA, like Taboola, and came down to 4 times EBITDA. So that wouldn't have helped. So the only thing that really would have helped is a much more aggressive, thought process or changing of style, and that is a very different discussion, that has a lot of risks and downsides associated to it that we just didn't do. Right, the only sector that was up significantly in 2022 was energy. It was up over 60%. So Alex, I don't know if you wanna chime in here.
Right. So basically, we certainly could have, and in a different world, would have mitigated some of the impact, but there was no way for us to materially change the outcome or change sort of the tone of this conversation. I think, Frank, the biggest lesson though of this all is not to let your emotions impact your judgment and decision making. The Global Advantage quarterly letter should be up on the website today, and the other 2 letters should be up shortly. I think half of the global letter was dedicated to describing things like loss aversion and how psychological damage inflicted during these kinds of bear markets often turns drawdowns into permanent losses of capital. We own high quality, long duration assets. They will come back. Psychologically, the lower their stock prices go, the more people want to sell them. Not because they need the money at that moment in time, but because they're scared and they can't take the pain anymore. But of course, it's really the other way around. Lower stock prices, lower purchase prices mean higher prospective returns and significantly more attractive risk rewards. We just have to make sure kind of not to let our emotions get in the way. And that's really the biggest lessons that we have from prior periods of time like this.
All right, perfect. So that's a good segue. So let's look forward a little bit and focus a little bit on your Global Advantage Fund, since that's your largest fund. Some folks might say this might be the buying opportunity of a lifetime when you have a talented investment team and a fund that came off of a challenging year. So can you talk a little bit? How are you positioned today? Did you change anything last year over the last quarter or so?
Sure. So is this a buying opportunity, right? I mean, essentially, I think that's what you're asking.
Yeah.
Well, sure it is. Sure it is. But the real answer is it always depends on your time horizon. When you think of this probabilistically, as we try to do with all of our investments, there is a range of outcomes. And there are really very few outcomes in that range where we are not significantly higher 5 years from now than where we are today. Certainly from a historical precedent, whether you look at the dot-com bubble or the global financial crisis, you look at pretty much any and every bear market, right? Corrections, pullbacks of this magnitude, they have always, and I mean always, proved to be good entry points some years down the road. It's just the question, how long is it going to take? So, buying something for half of what it was, 12 months ago is a good proposition from I think any perspective, assuming that you have the right time horizon. In terms of changes and portfolio positioning, you got to remember that we don't position our funds for any particular market environment. So we're not positioned for a recession today, nor are we positioned for a soft landing or a V-shaped recovery. We're not betting on 5% interest rates or 25 basis point hike or rate cuts in the second half of the year, right? This is just not what we do. We own a lot of Endava because we think digital transformation is a multi-decade shift and that they're really well positioned to benefit from that shift. We own a lot of NVIDIA, actually everywhere now, because we think the future of artificial intelligence is now, and that NVIDIA is at the epicenter of the AI revolution. As Guy mentioned, we own a lot of CrowdStrike because we think cybersecurity will remain a top priority for every government, every enterprise out there. And we own a lot of ASML because they have a monopoly in photolithography and in extreme ultraviolet, and you can't manufacture semiconductor chips without this stuff. And this stuff is really, really hard to do, like impossible, actually. And so we really love these businesses. We're very happy to own them at much lower prices, right? Basically at half off. And that's how we're positioned, and that's how we think of our portfolios. Guy, you have anything to add, to supplement?
Yeah, I mean, maybe a couple of points. I mean, during times of stress, instead of over diversifying, it actually creates an opportunity for us to increase the positions in which we have greater conviction, right? So when everything sells off, we can make the positions in which we have a lot of conviction and in which we see a very skewed risk reward for the long term, to make them larger. And that's kind of what you have seen this year, where the number of names in the strategy has come down, the proportion of the top 10 and top 20 has significantly increased. Now, the question we really ask ourselves when we do that, right, is what has, are our businesses resilient? Can they withstand a downturn? And the answer is unquestionably yes, right? Our companies have low leverage, they are leaders in their industries. And during times of stress, what tends to happen is that customers tend to consolidate spend on their best suppliers. So the companies that would gain market share during these times tend to be the leaders in their industries, or the companies that fill up the strategies. The other question we ask ourselves is, in terms of looking 5 and 10 years down the road, are the opportunities, or is the end game for these businesses, has that materially changed? Is that significantly different than what it was before? And for many of our businesses, again, the answer is no, right? While it may take 1 or 2 more years to get there, because it's unlikely that any business will not feel the impact of economic slowdown. Our companies will tend to come out of this stronger, higher, bigger market share positions. They continue to innovate and grow their addressable markets, and they continue to benefit from parallel distribution and and competitive advantages. So we believe that we own more of the best businesses in the world in a more concentrated fashion. And that kind of sets, I think, the strategy well for the long term.
Perfect. Thank you, Guy. Guy, you just used the word opportunity and best businesses in the world. Your fund is a global fund, and both funds have a pretty big opportunity set. In the global market, there's 64,000 publicly traded companies. So some might think you have the easiest job in the world because you only have to find 30 or 40 companies per fund. But I think when you have no borders and an opportunity to invest everywhere, no sector restrictions, no cap weighting borders, how do you source ideas, and how do you take 64,000 companies down to approximately 40 names in Global Advantage, or from thousands of companies in the other funds? And within there, what are the big ideas that you like today?
Guy, why don't you take this one as well? I'm actually looking at some questions that are coming in online, so I'm gonna think how to answer that. Why don't you take this one, Guy?
Sure. I'll start perhaps, and you can you continue. So I think we come back perhaps to the beginning of the discussion, where our focus, especially in global and FIF, is big ideas that are beneficiaries of disruptive change. right? And the question that we really ask ourselves, has this changed, right? Has the regime changed we've seen in the market, with the higher interest rates, et cetera, macro, has that changed what, big ideas can do over the long term and the pace of disruptive change and innovation? And the answer that we come out when we think about that is that the pace of acceleration and the pace of disruptive change has actually only been accelerating, right? So if you look at some kind of big picture data, and we put some of that in the letter, but it took 46 years for electricity to be adopted by a quarter of the US population. It took 35 years for the telephone, 25 years for television, et cetera, et cetera. It took 7 years for cell phones and 5 years for the internet. An interesting example, which is very recent, is AI, right? Artificial intelligence that Alex mentioned. In 1980 was the first year where a paper called Neocognition came out and enabled basically recognizing digits from one another. It took 32 years until 2012, where AlexNet came out, which is basically image recognition, being able to recognize a cat from a dog. At that point in time, also, people started using it. Was it's what's called the Big Bang of AI. NVIDIA came out and basically made their GPUs, or graphic processing units, which up until that point were only used in gaming, make them possible to be adjusted or used in in training AI models. So that was 2012. Last year, towards the end of last year, in November, ChatGPT was released by a company called OpenAI. I'm sure many have heard about it. It got to 1 million users in 5 days, which is unheard of. What ChatGPT does, for those that haven't heard about it, it is basically it's an artificial intelligence large language model, or LLM. It's based on a model called GPT-3, which has 175 billion parameters. And what it does, it enables you to ask, to log in and ask it questions, and then it answers, right? So it can do things such as help you write essays, or even help you write complex programming languages if you're a programmer. It is really extremely advanced. It's been widely adopted, and it kind of talks to the exponential growth that we are seeing in AI and how fast things are moving. Now, some of the names that we invest in that will benefit from this, and Alex mentioned NVIDIA, obviously Tesla comes to mind, GM Cruise, both of them are working on autonomous driving. And then we have companies that, that will benefit and enable big data, companies such as Snowflake and CrowdStrike and, and Cloudflare. But the big picture is that AI will be impacting various industries and economies, and will be a big deal in our view over the next decade. Alex, you want to chime in?
Nope. Think you covered it all.
Thanks, Guy. Alex, a couple of questions popped in. If maybe we can do a little bit of lightning round in light of the timing. A couple of questions on Tesla. One was, are you going to be adding more Tesla to the fund? And as you think about their price cuts, any concern on the demand side in this tough market environment for Tesla?
Sure. We certainly cannot discuss what we are planning to do or what we are going to do. We do believe that Tesla is incredibly well positioned. It is a leader in clean electric autonomous mobility. We think the entire transportation industry is going to go electric. We think electric is the winning technology. We think it's all going to go autonomous. And Tesla is most certainly a big idea. It's a company that has very significant leadership in a multi-trillion-dollar industry And its opportunity is larger than we have seen with any other company that addresses that space before. So we are very bullish on Tesla. We're going to manage the position size kind of as well as we can. But Tesla is a very interesting example, right? Today, Tesla, is coming off of a huge run, and the question is, why don't you own more? In the fourth quarter alone, Tesla stock was down 54%. And the kind of schizophrenic reaction that we're getting from the market, and Tesla is probably the extreme example, but we're getting it in many other companies. Tesla's low for the month of January is $101. Month of January of 23, the high is 175. And I think what Guy was trying to say earlier, certainly the intrinsic value of Tesla has not changed 70% in a 3-week period of time. So the stock price is driven by something other than fundamentals, right? Yes, there are price cuts, and yes, Elon's always in the news, and there's some litigation, and there are things going on. But Tesla's opportunity set has not changed dramatically in the last 3 weeks or in the last 3 months, right? And so whatever your expectation of its intrinsic value, now 3 years from now, 5 years from now, it has not changed dramatically due to price cuts or due to, General Motors and Ford's response, right? But the stock price does change dramatically. And so, I'm not exactly answering the question other than to say we are very bullish on Tesla. We believe their competitive advantage is unchallenged. The gap is probably larger today than where it was 3 and 5 years ago. And so we expect to own Tesla in size for the foreseeable future.
Okay, thanks, Alex. A question came in. I believe the primary reason last year that companies eventually will need to be profitable and be cash flow positive. What are your thoughts about the ability of fast-growing companies like Snowflake, Datadog, CrowdStrike, and others turning on the profitability engine, and when does it happen?
So all of these companies, each and every company that you mentioned, have already demonstrated the ability to be profitable. And this is very similar to what we have seen with Amazon, let's say 20 years ago, right? These companies are addressing very large markets that are growing very fast. And the reason why they're not showing high profitability is because they have the opportunity to reinvest all of their profits back into their business at very high and typically rising rates of return. These companies do not need access to capital markets. They do not need to raise cash. They're not burning cash. And so it's a balancing act, right, between growth and profitability. Interestingly, a year ago, a majority of investors would be penalizing these companies if they were showing profits at the expense of growth. Right? The advice from investors was pedal to the metal, invest as fast, as aggressively as you can, hire as many talented people as you can. Time to market more important than near-term profitability metrics, right? Every company that you just mentioned already screens extremely high on the Rule of 40. They all have high cash flow margins, right? They're simply trying to reinvest all that money back in their business. So, psychology is really what's driving it, Frank. And, let's look at Amazon. Amazon is probably, the easiest example. Amazon announced in late 2022, I believe in December 2022, that they were going to lay off 10,000 people. I think it's the first time they're doing a layoff, possibly ever, but certainly in a very, very long time. And when they made the announcement, their stock was down over 5% that day, significantly underperforming the category, the market. And the takeaway was that business is slowing down, and Amazon is finally, getting religion. They realize that they have to become more profitable, and they're doing a layoff, right? In January, it came out that instead of 10,000 people, they actually laid off 18,000 people. So this is just some weeks later, and that day, Amazon stock was up 4.5%, outperforming, because now the layoff was perceived as good. So in December, laying off 10,000 people is bad news because it signals that your business is slowing down, right? In January, laying off 18,000 people or 8,000 people more is perceived as good news because now you're going to be more profitable in the short term. Now, of course, any long-term investor should take a step back and realize that Amazon has 1.55 million employees. They have over 1.5 million employees, that 10,000, 18,000, we're talking about a rounding error. I don't think Amazon intended to send any kind of a message or a signal. They're required to file. They have to disclose a layoff of this size, and that's all that was, right? But the market responded very differently. The stock underperformed in December, got hit really, really hard. Now it's up, I think, 20% in January. In reality, absolutely nothing has changed. Nothing at all. And this is what we're dealing with. That's the issue.
Okay, so I see some questions of some people that know you very well. So the person came in and asked about, can you talk about, when you talk about risk in permanent loss of capital, there's a question about volatility. So I think a couple of questions kind of are surrounding risk. So can you talk how you manage risk, maybe your opinions on the phrase you've used in the past of permanent loss in capital? So how do you manage risk within the portfolios? Or what do you think about
I will. Yeah, I think you were shy to read the actual phrasing of the question.
You can reread it if you'd like.
Yeah, I'm gonna read it because I do think it's very relevant, and I'm sure that's how many people on this call feel. So the question is, 2022 markets and the phrase permanent loss of capital became an oxymoron. Not sure what we have learned from that, but would love to hear your thoughts. I think this is critically important to understand and internalize. It is not an oxymoron, right? There's, we use something called pattern recognition, right? We have seen this before. We have owned Amazon since the company went public, not in this strategy, I've only been a Baron for 11 years now, but I've been at it for almost 30 years. And I remember Amazon and reading Jeff Bezos' shareholder letter in year 2001, when Amazon's metrics accelerated and it became a more relevant, more important business on every KPI, right? In terms of share of wallet, in terms of growth, in terms of engagement, in terms of recurring revenues, purchases, more categories. And yet their stock price was down 80% that year. And of course, you fast forward to 2002, it was then down another 80%. Clearly, if you held on to, this is excruciating pain. You're talking, losing over 90% of its value. And yet, clearly, if you held on, it was not permanent loss of capital. I was working at a company called Morgan Stanley at that time. Morgan Stanley is one of the premier investment banks. But in 2008, during the global financial crisis, its stock price went from 100 to 6. 100 to 6. And I can tell you, many of my peers, we're talking professional investors, my colleagues at Morgan Stanley, were selling Morgan Stanley stock exactly at that time at 6. Right? So this is when your $1 million stock holding becomes $60,000. And it wasn't going to make a difference to anyone, but no one wanted to hold the bag, and the pain was intolerable. And it felt like the world was going to end, and so you sell it. This was not a good decision, right? I held on, and it was not permanent loss of capital. The stocks recovered all of those losses, right? And basically went up 20-fold since then. Amazon has gone up, 2,000-fold since then. So, yes, there are tax losses and, other things, but this doesn't have to be permanent losses of capital. Just like we talked about Tesla, just like we talked about, Amazon, psychology drives stock prices. over short periods of time. And so we do differentiate between volatility or stock price volatility and businesses' intrinsic values. We're highly confident that Amazon is not going to go away. We're highly confident that Tesla is going to be worth significantly more 5 years from now than it is today. Highly confident. So these don't have to be permanent losses of capital. I think this is, if there's one takeaway, from this call, is I don't know how to articulate it any better. But this is a very important message to kind of understand and internalize.
Perfect.
Go ahead.
Yeah, Alex, I think it's a pretty obvious characteristic of all your funds that they're fairly concentrated with high conviction names. Last year, you ended up with 29 names in both Durable and Fifth Advantage Fund. Your global fund ended up with 41 names. You have an active share of 98% in your global fund, which is about as high as you can get. So can you talk a little bit about, concentration and what we mentioned before about 64,000 companies to talk to you? How do you actually narrow that down and pick the best companies in the world, and maybe talk a little bit about some of your best high conviction names?
Sure, I think we touched upon a bunch of them already, and I think Guy kind of touched upon, our attitude towards risk. I guess if it wasn't obvious before last year, it is now that we are not good at managing volatility. And the reason we're not good at it is because, just to be blunt, we don't believe anyone can manage volatility well over long periods of time and add any meaningful alpha to long-term returns. And for us in particular, being long-only, unlevered, mutual fund, we don't have a lot of tools in our bag. We're not allowed to short, right? Not that that's our skill set. We don't buy put options. We don't make market calls. So, yes, you could try sector rotation, right? Guy's analysis, you could try to change who you could buy convertibles. You could try to make market calls and kind of manage market volatility. But in our experience and in our view, it is very difficult to do well on a consistent basis because you have to get timing right on both ends. And bottom line, this is not who we are, right? So we prefer to guard against over-diversification. We think over-diversification and not having enough active share is what's caused many active managers to dilute their returns and to dilute their opportunity to generate alpha over full market cycles. So we think our process is time-tested, and it is proven to generate significant amounts of alpha over full market cycles. It is difficult to trust it, I guess, or to believe it after a year like 2022, but it does happen every now and then, and we have stayed the course in the past, and it has always worked out. In fact, looking from, if you evaluate it from the time of the corrections or after the corrections have happened, it has proven to be a really good entry point basically every single time. And so the reason why we concentrate, Frank, is that we want to make sure that our highest conviction ideas have a lot of weighting so that if we're right, our shareholders get the full benefit of that research and of that conviction. Guy, anything to go ahead?
Just one quick point. I believe 2022 has been the year where value stocks outperform growth stocks by the widest margin in over 20 years. Now, kind of to Alex's point about rotating sectors, the main issue with that is that, and when you kind of try to find and, and say, let's hold on to one of these lower quality names because because we realize there is a regime change, is that you really have to have a lot of conviction on when do you sell, right? When you hold a lower quality name, the intrinsic value will not compound over long periods of time as fast as it would in a big idea, which means that you're really fighting and you're working against time. Now, what we prefer to do and where our skill set lies is in really identifying those big ideas, buying them at fair prices, and during these times at actually really attractive prices, and then holding on to them. So stepping outside of that will be stepping outside of circle of competence, and will be us fighting against time, and that's why those are the two biggest, I would say, downsides to doing that.
Perfect. Alex, you touched on this a little bit, but I think when you manage 3 funds in a global fund, and even though we're not a macro manager, we still get a lot of questions on that. So, with the Fed meeting, everybody's talking about they're going to raise a quarter. With recession, inflation, China tensions, Ukraine, pretty much it never ends. So with all the portfolios you manage, you have to factor in global and domestic. So kind of maybe how do you factor all that in when you're picking, the 80, 90 companies that you manage throughout the 3 funds?
Frank, the simple answer is we don't. We are aware that there is a Fed meeting today. We know that they will release the information tomorrow. We know that the market's pricing in 25 basis points, but we do not take any investment action based on this information, right? We try to understand artificial intelligence and why NVIDIA's leadership position is defensible, durable, insurmountable. And that gives us confidence in projecting what NVIDIA's revenues and profits would look like 3, 5, and 10 years from now, right? We look at, Tesla, right? And we look at the size of the private car park or transportation, and what market share assumptions we can underwrite and support, right, based on their ability to manufacture and on the strength of their brand and on the business model and profitability profile that we believe we can underwrite. And that's really all we do. And the stock prices in the short term will do what they will do. Now, what happened in 2022 is all the news was perceived as bad news. There were shocks to the system, right? We had 4 consecutive 75 basis point hikes, which were bookended by 50 basis point hikes on both sides. So interest rates basically went from 0 to 4.5% in the course of 5 months. This has never happened before. This is a shock to the system, right? No one knew even in January, a year ago, that Russia was going to start a war in Europe. I mean, there were risks, right? People were thinking about it, and that there could be supply chain disruptions, right? No one knew how COVID was going to play out in China. And by the way, today's news is, apparently we're going to cancel COVID in the United States, right? It will no longer be a pandemic or an emergency. It will be just treated as a flu. So where I'm trying to go to is that there are periods of time when all the news are perceived as good news, and there are periods of time when all the news are perceived as bad news. Just like the example of Amazon's layoffs, right? In 2022, all news were bad news. And you look at 2023, it seems to me that it's starting to turn, right? Who the hell knows? For now, earnings are better than people think. The international, if it's monetary fund or whoever, raised the global GDP prognosis today from 2.7 to 2.9. Right. On one hand, everyone's talking about recession and how it's unavoidable and how it's inevitable because we have the inverted yield curve, and we don't know, right? And we're not investing with a recession or a soft landing or any kind of thing in mind. What we are doing is we are making what we believe appropriate weighted average cost of capital assumptions on our businesses, right? So the cost of capital have gone up, and that brought down intrinsic values of many of our businesses. But the majority of the declines that we have experienced were really due to multiple compressions, not estimate changes, not changes in intrinsic values. I think in global, we have experienced a 57% multiple compression. And in fifth, it was 53, obviously 53%. It was less than that in durable. But again, we think certainly majority of it will not result in permanent losses of capital.
Perfect. Are you able to comment on Rivian? We had a couple of questions on what went wrong with Rivian and any lessons that you learned from Rivian that might apply to Tesla.
Sure. So I've talked about Rivian, I think, on every call for the last 4 calls, where we described, how we did the due diligence, how we visited the company. We've owned it as a private. We've owned it for, I think, 1.5 years, maybe almost 2 years before the company went public. It went public at the absolute peak of the cycle. In terms of mistakes, I think for me specifically, I got a little bit too excited. I missed Tesla. I missed a big turnaround in Tesla that happened in 2020 and 2021, and was eager to apply my pattern recognition to another company that was, in many cases following Tesla's blueprint. I was absolutely enamored with RJ Scaringe, the CEO of the company. And I do think I became a bit too emotional, and I wanted to get as much of it as I could. And I perceived it as a truly scarce commodity. And all of our experience suggested that we were not going to be able to buy, the size of the position that we wanted. The problem is I wasn't the only one who felt that way. There were many other market participants that did the same. It became overheated, overexcited. They raised the price of their IPO by 25%. So the purchase price ended up being significantly higher than what we thought it was going to be. And in order to get an allocation, we basically, groveled and made commitments to the management team that we were going to be there for the duration of the journey. That we can stomach the market volatility, because historically we always have. That we're not worried about a quarter or two. We're not worried whether they're going to make 50,000 cars in 2023 or 25,000 cars. It didn't matter to us, right? What mattered is what they're going to do in 2030. And we believed in the vision, and we believed in the management team, and we believed in the marketplace, and we believed in the product, and we were going to be there for the duration. And so we did a little bit of a too good of a job, where we convinced them that we should be one of their partners. And we got one of the largest allocations, I'd say the largest that I have had in my professional career as an investor. And, this was November, I think, of 2021. And so then there is a regime change, and, everything goes the other way, and we have reputational risk because, we made commitments and we made representations, and we said, this is who we are. And it is who we are, right? Of course, what you want to do isn't necessarily what you can do, and, you have redemptions and other things. And now, in fairness, the management has made a number of mistakes as well. The execution was far less than stellar. And by the way, so did Tesla in the earlier stages. And probably the biggest difference between the two companies today is that Rivian is where Tesla was, 4 or 5 years ago, right? They're in a much earlier stage of their life cycle. Tesla is going to make, 2 million cars, and Rivian's going to make, maybe 50,000 cars. Mm-hmm. And so that's a huge difference. And during the times of uncertainty and stress and reduced time horizons, companies that are in the earlier stages of their life cycles become disproportionately affected. Nobody wants to own them. And so we haven't lost conviction in Rivian, right? We still believe that it's the right company, the right product, the right management team, despite the fact that they have stumbled and shot themselves in the foot and cut their noses and, made all kinds of mistakes, right? But we're basically talking about a company that at the end of this year, at the end of 2022, will have $12 billion of cash on the balance sheet, and the market cap is like 15 or 16. So you're really not assigning much equity value to the rest of the business. Now, yes, they're going to be burning cash for a while, right? They're building out plants, they're spending a lot of money on CapEx, but their product is unique. I think the confusion is because everyone is now rushing to make electric vehicles, people think that they will get commoditized and, Ford F-150 or GM, whatever their comparable product is, or Jaguar or whatever. None of them come close to what Rivian has done. Their product is spectacular. It is unique. It is differentiated. They absolutely nailed it, despite the fact that they, screwed up the pricing and didn't handle the stress all that well. And so, the lesson was our position size was terrible, right? We had to say, okay, we made, we meant what we said, but the world has changed, and at the end of the day, we are fiduciaries and we have responsibilities, and this price is just unjustifiable, right? It'll take you 5 years to be able to justify the current price. But, everything was happening really fast. It was really dynamic, and we thought, we need to protect our reputation in order to, maintain relationships and kind of be true to yourself, and that's what happened with Rivian. I'm sorry for the long-winded answer.
Nope, that was perfect. That's what everyone wanted to know. So we're bumping up against an hour, and I appreciate everybody's time. Thank you, Alex and Guy. Most importantly, I want to thank everybody for joining us today and for your loyal support of Barron Funds. If you have any questions, please reach out to your local Barron contact. And of course, there will be a recording of today's call available at barronfunds.com. So thank you, Alex and Guy. Thank you, everyone, and have a great day.